All right, how's it going, guys? We're going to be going over some reasons why you guys are losing money trading options. Now, there's a lot of mistakes you guys are making, so make sure you stay until the end of the video to make sure you learn and understand what you're doing wrong. So, first of all, a lot of you are just buying random call and put options just because you think the stock is going to go up or down. Now, doing that just blindly is going to be pretty risky. It's actually a less than a 50-50 chance of winning just because if the stock does end up staying flat or it just goes slightly in your direction, you can still lose money. So just buying random call and put options without any research or good reasoning is going to make you lose a lot of money if you continue to do so. Now, of course, you can get lucky and win big, but most of the time you're going to be losing on those contracts. Options trading does not have to be risky, as many people say. I've been trading options for quite some time with a high chance of profit with some steady income. Another reason is a lot of people are just buying weekly call options. Call or put options. And that's very dangerous when you have a shorter expiration, just because you have less time for your contracts to play out. So if it doesn't go your way, you're basically losing all your money on your contracts. Now, it does seem very appetizing to do something like a weekly expiration, May 6th, and doing something far out of the money. If we do something like a 420 expiration date, as we can see, we need the stock to stay above $423 by expiration, which is the end of this Friday, in order for you to start making some money or for you to start breaking even, which is a pretty big movement for SPY. It's almost a $10 price movement in just 1 week. And you are going to be paying $368 for this contract. So, in my opinion, you're most likely going to be losing money on this most of the time if you're just going to be doing weekly call options that are pretty far out of the money. The further out of the money you go, it is cheaper, but it does have a lower chance of profit because you need the stock to move a bigger movement in a shorter amount of time. And that's just very unlikely and going to lead to a lower win rate. Now, of course, it's gonna decay during the weekday as well, just because time decay is very apparent. As we can see, 0.54. The higher out of the money you go, the shorter expiration, the more theta you are going to have, which is the time decay. So every day that passes, you're going to be losing approximately $54 dollars on your contracts just from time decay, because contracts that have more time on it are worth more money and have a higher premium on the contracts. That's why expiration dates that are about 30 days out or even more have higher premiums, just because the time decay is not as big as something with a shorter expiration. Um, so that's another reason as well. And another reason a lot of people are losing money trading options is because they're just doing single leg options. They're just buying calls or buying puts. They're not utilizing other strategies such as spreads, whether it be credit spreads, debit spreads, or even multi leg options such as iron condors. And these advanced strategies can drastically increase your win rate just because of the benefits they offer. Now, the first benefit, something like a spread offers, and we'll do an example here. We'll do, for example, a call. We'll do a call debit spread. So we're going to be buying the 420 and then selling the one over it. And it's going to be a call debit spread. So our chance of profit is going to be a little bit higher than just buying a straight up 420 strike expiration call option. Um, and it is going to cost a lot less as well. So that's the second benefit. So two benefits. The first one, it's going to be a higher chance of winning. Second benefit is it's going to require a lot less capital up front. But the downside is your max profit is capped. But that's okay, because when you're trading options and you're doing it consistently, you can definitely grow your portfolio pretty fast with consistent wins rather than one huge winner from a really risky call option lottery ticket. So that's another reason. Now, if you want to do single leg option strategies, selling options is a lot safer than buying, because, as we mentioned earlier, buying something like a 420 call option is going to be a low chance of profit. Um, but if we do a sell call, which is called a covered call, it is going to give you a pretty high chance of profit. And the max profit you are going to have is actually going to be the premium. You're not paying this premium, you're actually receiving the premium upfront when you're selling options. Now, of course, selling a covered call is going to require you to have 100 shares of collateral to put down in order to write the contract. But if you do have enough capital to sell options, you should definitely try it out because it can really bring in some nice weekly or even monthly income, and actually can actually replace your 9 to 5 job if you have enough capital to do so. But if you want to sell put, same strategy. You want to do out the money calls and puts when you're selling options, just because you have a higher chance of profit, and it's going to be more consistent. So we could do something like a 410 expiration strike price. You're going to collect $300 of premium there. And as we can see, it's going to be a short put, cash share put. So instead of having 100 shares of collateral like the call side, we are going to need the strike price multiplied by 100 shares to put down as collateral. As we can see here, if we take go, you're going to need $41,000 of collateral to put down in order to sell this contract and collect $300 of premium, which is pretty sweet. And the downside of cash gear puts and covered calls is you basically have to sell your assets at the strike price you chose. So in the case of a covered call, we would have to sell our shares at $420 per share, which is going to give us a capital gain, pretty nice capital gain as well. And the downside to a cash geared put is we have to buy 100 shares of the stock at our strike price, which is pretty good considering that SPY is at 416. So we're getting shares at a cheaper price. If you do want to buy options, though, buying it out about at least 30 days out is probably the safest bet. So you want to do something like a June 6th expiration date. Give yourself some time for the contracts to play out. The market's very shaky. It's very hard to time the market. So by giving yourself more days and more weeks of expiration, you can allow yourself to have a higher chance to win on your contracts. Even though my recommended strategy is selling options rather than buying them. Even buying them a year out is going to be a very good strategy as well. And when you're buying call options, you want to buy them probably at the money or even slightly in the money to give yourself the highest win rate possible. So that's about it for this video. Thanks for watching.